Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.
Hey guys, welcome back to another episode of the Tall Oaks podcast. Today I have a very special guest, a friend of mine, Mike Taylor. And I don't want to spoil too much of Mike's career here and speak for him and what he's done throughout his career. But I will let you know that he's had a very exciting career. And the spoiler alert I will drop is that what he's doing now with an ETF, the ticker on this one in particular is PINK or pink. It is, as far as I know, the only ETF out there with a philanthropic component to it, where the management fees get donated to, in this case, the Susan G. Komen Foundation, which advances cancer research. So with that, I'm going to, kick it over to you, Mike, and ask you to introduce yourself and just tell us a little bit about who you are and what you've done throughout your career that brought you to now running this really interesting, one of a kind sort of ETF that's been out for a couple of years now.
It's been out for 4 years. This is our 5th year running Pink with the Simplify family of funds. And we're so pleased that they set this up and have enabled this because they don't make money on it. All of the net fees and my compensation goes to the Susan G. Komen Foundation for breast cancer. And Pink is a largely healthcare angled, actively invested fund. And it invests in everything in healthcare across the world, and also some things a little bit outside of healthcare but related. So it's always going to have a meaningful healthcare bent to it. And I'm very pleased to say that you'll have to look at our performance, and feel free to compare Pink to any other comp in the world since inception. And I think you will find that our returns have been good. And I'm only allowed to say so much about it on the return profile, unlike Kathy Woods, who is allowed to promote and predict the returns of her future fund. So we don't do that here at Pink for legal purposes. But I'm also one of the larger shareholders in Pink personally, and I don't take any compensation to do this for the past going on 5 years. And we're just so happy to help out the folks at the Susan G. Komen Foundation to advance research and help families with breast cancer. Because it's not just a young lady who gets breast cancer, it's a whole family. Yeah. Everyone has to go through it. And we are very, very pleased to help raise awareness, raise money, and do good. And by doing good, you can also do well with the Pink ETF.
Well,
so that's Pink in a nutshell.
I think that's the interesting component, right? Is like there is this component of doing well and this charitable and philanthropic component to it, which is very unique. And I'm not aware of any other ETF personally that has that type of component where it's essentially sort of a nonprofit that way. But the person at the helm driving it is like, what I want to highlight is like, it's also not just an index fund, right? It's not that it's just on autopilot and it's market cap weighting, healthcare companies and then kicking out some small benefit to, a philanthropic opportunity. This is something that you're working on actively, I presume pretty much every day, knowing you.
Full-time. It's a full-time job. Well, let me describe the job description.
Yeah.
And this is why there are no funds like Pink anywhere in the world. And there probably never will be. Because the job description reads like this: full-time job for somebody who has a positive 20-year track record running a hedge fund and experience running a healthcare fund on top of that. Who's going to work more than full-time, travel around, do their job, pick the stocks, and get paid zero to do so. And that's basically the job description. And so it's a pretty hard job to fill. You have to find someone who, there's very few people that have that kind of experience and that track record, and then are willing to do it for nothing. And but it's not for nothing. It's for millions of people and families that suffer from breast cancer. And for that matter, any cancer, because as the discoveries get laid out for breast cancer, it also applies to many, many other cancers at the same time. So it is a unicorn, as one of one. And fortunately, we've gotten a lot of attention of it. We go and ring the bell frequently at the New York Stock Exchange with the Susan G. Komen Foundation. And there was a wonderful article last year written up about this fund in Forbes magazine, and I applaud them. They're the first ones to pick this up after 4 years of being out. And I'm very pleased about that. So it's been good. And now we're on many, many more platforms as we're in our 5th year. And there's real traction in asset growth in the fund, which is wonderful to see. And I honestly thought that the performance would have driven it sooner, but I've learned a lot about how marketing really works in the ETF space. And it is much, much, much different than hedge funds. Hedge funds that I've worked in for most of my life, if you have the performance such as we do, we would be closing the doors down and sending money back because we just couldn't take it. It would be just an avalanche. And that's not exactly how the distribution model works in the ETFs. So that is a learning curve for me. I think we're on top of it, and the assets are growing very well now. But it did take about 4 years to get to this spot.
Yeah, the retail space that's of ETFs that are publicly available to everyone is, from my understanding, that's normally the world that I operate in, is very different than the world that you've operated in throughout your career. And so, talking about the experience needed to run something like this, or the job description, the qualifications, would you mind spending a little bit of time talking to us about your
Sure.
your career track record, or not the performance component of it, but what industry did you start in? Where did you go? What are some of the things that you've done throughout your career that helped build this experience for you?
Well, it like many people who end up in doing what I do, it is a nonlinear path to find the destination. I started out as a scientist developing the first generation of gene therapeutics drugs in the 90s. And then I discovered in my late 20s that this job existed. Holy cow, you can be a scientist and bet on what's going to work and what's not going to work. And so after grad school in science and working in science, I went to business school to learn what finance was. And I was very fortunate to get an internship at Oppenheimer Funds. And shortly after that, I ended up becoming the head of healthcare at Oppenheimer Funds. And after some management turmoil, which happens often in the financial space, I moved over to something much more secure, which was a hedge fund. And I immediately found out that's not secure at all. And so I ended up going to another hedge fund. And then I went to Citadel. And then Millennium made me an offer I couldn't refuse. But all the while, my book got bigger and bigger and bigger. When I went to Citadel, I think they gave me $1.5 billion book. And at the time, that was a monstrous book. That was a top 10 book in the world at that time. And this is 15, 16 years ago or so. So that was pretty amazing. And then there was some management turmoil there. And Millennium came by and made me an offer I couldn't refuse. And I spent most of my career at Millennium sitting in that chair. At the time, I didn't even know that Citadel and Millennium were the big dogs. It's like the Yankees and the Red Sox. I didn't even know. I just was pleased that they could give me a large book to run and I could build a great team, and they wouldn't bother me much. Just let me do my thing. And that's what we did. Built a wonderful team who I'm very, very close to this day. And they are all... I'm very proud of them, and they are the gladiators, the masters of the universe in healthcare right now. And they're my best friends in the world. And we're all weird, that most of us are scientists or extremely idiosyncratic thinking, mathematical individuals from disparate backgrounds. One of my right-hand guys wasn't even a scientist. He just picked it up on his own. He's so smart. Just became a scientist sitting at the desk. And that's how bright some of these people are that I got to work with. It's stunning, stunning. Some of the smartest people in the world I've been fortunate to interact with and work with. And many of them are now in the White House and have meaningful roles throughout the world, which I never expected. And I talk to them, and it's wonderful. Like Mike Green and Scott Pessent and Pulte, and many, many, many others throughout that are having a huge impact on policy and the shape of the world right now. It's a very small group of people, and we chat because we all have the best interest of the country and the world at hand. So anyway, that's my background and how I ended up here. And how I ended up with Pink is that I ended up semi-retiring for medical reasons about a decade ago. And then once I got well enough, we started Pink about 5 years ago. And it was really, I was at the point in my life where I don't have to, I'm fine if I didn't make any money. But I was going to do this no matter what, trading healthcare. So I might as well do it for something really good, something really different, something that nobody's ever done or nobody's crazy enough to do. And we came up with Pink. And I'm so thrilled that it's worked out so well for everyone. So I got to pinch myself every day that I'm lucky enough to do this at all, whether it's to get paid or for free. And honestly, I'd be doing it if I wasn't paid, which I am. So here we are.
Yeah. Well, there's so often when I'm working with, you come from the hedge fund space deep in Wall Street, for your career. And I very much operate on, what I call Main Street, working with normal people and normal people's retirements and this kind of thing. And there's this big narrative always that, the S&P has really become kind of the S&P 500 was the only game in town. And, it was this clear choice, and it's done so well for so long that, when you talk about something like healthcare, it oftentimes get overlooked. What you combine that, I kind of want to talk a little bit about what are the opportunity sets for healthcare, or, why do people even invest in healthcare, and should they consider it? Is it a diversifier? Is it a conservative play? What are the opportunities in healthcare?
Well, there's a few things. Healthcare is 18% of GDP, growing to probably 20%. And it is a massive piece of our economy. And it is certainly underrepresented in folks' portfolio for the most part. And part of the reason is because it is so diverse, so idiosyncratic. It's very difficult for the common person to decipher what's good and bad. Like, for instance, DuPont and Dow and Caterpillar and other things, they all have, like in the cyclical space or the consumer space, they all have extreme overlap in what their business is, high correlation. And it's relatively easy to model and understand. Whereas healthcare, the difference between Lilly and Johnson & Johnson, there's almost no overlap in their businesses. And these are $1.5 trillion companies. With no correlation to each other. And you can say the same for pretty much AbbVie and Merck and Amgen and Gilead and Pfizer down the line. And then that's not even to talk about the HMO space or medical technology. So these are all very uncorrelated businesses. And that presents us with a set of incredible opportunities because they all function differently and they perform differently at different times. And so there's a lot of money to be made in figuring out the spreads. Is Johnson & Johnson going to outperform Lilly? How and why? But the downside is for the common individual is it is very difficult. I understand it's difficult for the masses to understand it because they really don't understand the products. They don't understand the product cycles. They don't know the pricing. They don't know the distribution. Whereas if you just look at Apple and an iPhone, pretty easy to understand how it's made, what it's made from, where it's sold, how much it's sold for. None of those things are terribly transparent to the average person in healthcare. And that's a large reason why it gets overlooked to a degree. but it really needs to be a meaningful part of anyone's portfolio. We are in a golden age right now of discovery and development, truly a golden age, where the technology is vertical. It is just straight up with new mechanisms to deliver drugs, new ways to treat, new ways to do surgery. It's really endless. And we're just at the beginning of the on-ramp to where this is going to go. So it's incredible. I'll give you an example. Back in my time when I was developing drugs for gene therapies, for instance, it would take about 7 years to get from an idea to the drug testing in humans. And that was actually pretty good. Now it's sub 3. You can go from an idea to humans. That's absolutely incredible. The velocity has exploded in how quick you can go from an idea through animal testing to humans. And a lot of that is due to the scientific machinery that makes all the experimentation much, much, much faster and higher fidelity. So we end up having higher fidelity drugs that fail less frequently, especially around toxicity issues, and get into humans and change lives very quickly. I can promise you, for just about any major illness, that 10 years from now, the assortment of drugs and treatments available will be completely different than it is today. So that's incredible innovation. And that acceleration has just really taken place in the past 20 years. And I know that sounds like a long time, but really, in the view of humanity, this is a blink of an eye. 20 years. It's nothing. Humans have come ungodly far and a very, very, humans just got interesting in the past 100 years, and that's it. You think about it. Light bulb, new. Electricity, new. Communications, new. The automobile, new. The toilet, new. That's what happened 120 years ago. And then 60 years ago, almost 60, you got a man on the moon. And then here we are now, really starting to understand the biology of how we work. And we're just at the beginnings of this. The next big, really big thing is going to be anti-aging and altering the aging curve for humans. And there are a number of things in development, really at the science stage, but that will be the big frontier for humans, is living longer and more gracefully, where our productive time on Earth is no longer 35 years. Our productive time on Earth as an adult from, let's say, 20 to 55, right now, that's really your most productive years, 20 to 55. You get 35 years, and that's it. Where would humans go if that number was 300? What could be done? Incredible things could be done. Incredible things could be done and will be done. And it is going to be biology that unlocks the next frontier for humans. It's very exciting, and I'm thrilled to be a part of it. This is why this should be a meaningful part of anyone's portfolio.
Yeah, that's man. You said 300 years. I can't even imagine what it would be like to live for 300 years. That would
be
put
very,
me
very different. But you'd live gracefully.
On that type of time scale, like
for a long time.
On that type of time scale, I'm still like an infant. I'm still like in kindergarten.
Well, I'm 53 and I'm still an infant. I wake up every day and I have to remind myself that I'm an amateur. Yes, I have a track record, and 1 year I'll underperform. It'll happen someday. But I always look over my shoulder, always fearful that I will underperform, and that's what keeps us going. Nobody ever wants to underperform. And I've been fortunate enough that it hasn't happened yet. But if I was able to do this for 100 years rather than 30, wow, I might be really, really, really good at this by year 70. And that would be very exciting. I'd love that. But it will change the fabric of humanity. It'll change the value of life. Life will become very, very, very valuable if you live for 300 years. Those are exciting things. And yes, there'll always be problems, social problems with things like that. But honestly, there are only 2 things that humans do not want to do: pay taxes and die.
I think those are
And
the
I
two
see no
inevitable.
solution for the tax problem. So,
Yeah. Uh, well, that's it. That's actually a really interesting point. And maybe this is a little bit too deep in the weeds or off topic, but the thought that just came across my mind is, man, if you live for 300 and people are expecting Social Security and Medicare benefits at 65, that poses a pretty big problem all of a sudden. And what does that do to a financial
well,
system and
retirement age
taxes
just gets
collection?
moved to 302,
In theory,
right?
but
Problem solved. So,
yeah, congratulations, everyone. You got to work till you're 300.
yeah. Well, life becomes very different.
Yeah.
But human innovation, if you think about that, all the problems that we can solve would be astronomical, parabolic. So many brilliant minds that we lose to age. Now we wouldn't lose to age.
Yeah. I think,
and that would change everything.
The other thought that just came into my mind is, this is going to sound off topic at first, but this idea of Warren Buffett and the long-term investor, right?
Mm-hmm.
So everyone always says like, I'm a long-term investor. I'm a long-term investor. And they say, I want to, when I was in college, they teach you the Warren Buffett way. They teach you the dividend discount model. They teach you this idea of like, hey, you don't look at performance on a year-to-year basis, or even a couple of years. Like you might have to buy a stock and, wait 10 years for it to do what it does. Or you might, things aren't linear and you don't know when return's going to come. You have to stay invested. You have to be a long-term investor. And people point to Warren Buffett all the time as this with, something like Berkshire. And I think one of the things that the disconnect of reality, and I know that you have talked about this prior, and maybe just not in this context, but the same concept. You say it in terms of like, the only thing that matters is the next 6 months. And I think tying it into Main Street, the reality is like most people, they can't wait 10 years because their life, they're trying to, they're not long-term investors, really, they're long-term savers. And they're trying to save towards this goal of retirement. They're trying to save towards something, and they need assets to grow. They need cash to flow. They can't buy something and have it be dead money for 9 years, but it'll pay off in year 10. They could maybe if they knew it was guaranteed, but that's not how it works. And people forget that Warren Buffett, though, by 30, he had $1 million, and that was in nominal dollars at the time. So this is like quite wealthy already. He kind of didn't really have a need for anything. And so he could say, yeah, no, the rest of my life, I'm a long-term investor because I literally will never really truly need the money. And the more it went on, the more and more that he was truthfully a long-term investor, that like my time span goes beyond my life, right? His investing time horizon, he just doesn't care. There is no end date to his investment, thesis. There's no need for the capital to be returned to him.
You have to remember, I have to interject here.
Okay.
Warren Buffett was the original private equity investor. And when I say private equity investor, I mean he discovered what's called the float. And he discovered that insurance companies take all of that reserve, the cash reserve that they have for that rainy day that they have to pay out. And typically they matched duration and they bought treasuries with a known return with no volatility in that return. And that's how insurance companies worked in the 1960s. And he found an insurance company called Geico, which was a very, very good insurance company because they only insured military people. And surprise, surprise, military people almost never burn their house down or crash their car. So it was priced like a regular insurance company. He was able to acquire it over time and then buy the entire thing. But he didn't just buy it for that great bias in the clientele in Geico. He bought it for the float. All that money that sat there in reserve, he discovered that he could buy stocks with it instead of treasuries. And he only needed to generate, let's say a 4 or 5% return, which was the treasury return then. But stocks were yielding 9. So if he could find names that could yield 9 or better, he'd essentially be borrowing at 4 or 5 and buying a yield at 9. So he could basically get money out of nothing as long as stocks returned. And he figured over the long enough duration, the market risk premium at that time around 9 would serve his purposes. And it did. And that's how he actually made all of his money in the beginning. His huge big move was Geico and investing that float in stocks because he had the money for free. No one else did it. No one else thought to do it. That was the innovation that Warren Buffett did in the 1960s, 1970s. And then by the 1980s, he had amassed so much money, so much return from that float that he could start doing exotic things like taking over banks and being the last stop investor in a financial crisis and end up to buy Bank of America at $6 and individually bail them out with massive warrant coverage. Made a freaking fortune, but he was able to do that over and over and over again. And then what he realized is, well, if I just buy duopolies or monopolies, but duopolies are easier to find, like the railroads and other things like that, he could end up having pricing power and end up growing a little bit more than that market risk premium. And then he looks at how much he's borrowing that money for from the insurance company at 3, 4, 5%. Sometimes it was at 1%, 2% in recent decades. So he could make this incredible ARB like a private equity investor. So really that was the secret to Warren Buffett's greatness, was that his cost of capital was lower than everyone else.
That'll do it for sure. I think the point that I was trying to drive towards was that there's a disconnect between what people perceive the Warren Buffett way to be, which is be a long-term investor, and what their real capacity to be a long-term investor is. Right. And that's where you say, excuse me, that's where you say things like, what really matters is the next 6 months on Wall Street. The only thing that matters is the next 6 months. And I think for Main Street investors, it's probably really more like the next 12 to 24 months is really what seems to be the impactful drive. But, I can tell you, working with Main Street investors, if you buy a stock and say, well, I think it's going to, it could go flat for 9 years, but by year 10, we don't see how it can't pay off. You've got about 36 months, if you're really aggressive about maybe writing and making your case for it, that you might be able to get people to hang on. But the attention span isn't there. And the reason I think the attention span isn't there is because they need to see the progress going towards their goal, because their goal is approaching, whereas long-term investors, sometimes again, Warren Buffett, he had so much capital, he didn't need the money back ever, right? And so you can be a long-term investor, but if you start living 300 years, that changes things, right? Like I wonder how that plays into behavioral finance and investing, and then the effects that has on the economy, because capital isn't rotating, it stays deployed into meaningful endeavors that people can wait for, the company to do its intended thing.
Well, if you think about investing, think about it, and this you probably won't hear anywhere. This will have a piece to do with Mike Green's work that you'll be able to read about in a book that's coming out very near term. I have the dubious designation of writing the book jacket. And I told Mike that you realize that the book jacket is the piece of paper that ends up on the floor around the toilet. And he's like, oh yeah. And I'm like, I think that's appropriate for me. Thank you. So the model works if every year there's more investors coming into stocks, if the population is growing or the number of people filing in is growing, the model works. It doesn't work if we have negative population growth and more people are retiring than coming into the workforce, because they will be drawing on this stock of savings. And if they're drawing on that stock of savings more than the dollars coming in, stocks and their savings will go down. And we saw this happen in Japan last decade. And what Japan did was they started printing money and buying stocks to prevent this from happening. And Japan now, 10 years, 11, 12 years later, is at the distinction where they have inflation, negative population growth, and they cannot stop accelerating money printing. The masses and the public are not understanding this, and they are absolutely not prepared for it. And we're on the cusp of that in the US, and we're already pretty much there in Europe. So that is a very, very different dynamic that will happen moving forward. So I think that ultimately what will happen for the US is that we are going to open up, not open our borders, but open up our import of people so that we go back to positive population growth so that this model can continue to work. There's a lot of value in building capital markets because it lowers the cost of capital to innovate and create innovations such as medical technology. So, but so far as the Main Street investors out there, by and large, just by a fact, they're going to have to be ignorant on how the plumbing really works. If they knew, they'd be a lot madder at the world, at the policy, at our politicians, and so forth. But they aren't, because there is a very, very hardworking, concerted effort in order to make it so that the public is not educated in mathematics and finance and so forth. Do not want them to know. And that's my only conclusion, because they don't know. It's the most important thing that you should know. And they're not instructed this in school or even business school. And that can't be by accident.
Well, I think in the world we live in these days, people look for the easy solution, right? So
any world in any time. Yes.
Yeah, like they're looking for the easy solution, but but it seems like a big thing, right? Investing and saving for retirement seems like a big thing. So you want it to be easy, but you also want it to make sense, right? So all of a sudden there's this narrative that, hey, just everyone put not all, but everyone put most of your money in, say, like S&P 500, or even, hey, everyone, if you have a disbelief in that, everyone buy, a townhouse or a condo as an investment property. Everyone buy these things. It's this, it kind of has to work, right? And what's happened is, like, as the narrative's been adopted, it's worked almost better and better, right? But I think what you're alluding to is there's some potential demographic shifts that could come into play and unwind that trade in a really unsavory way. I think what I'm hearing you say.
Yeah, and we're there. So I'm very acutely aware of it. U.S. is around that time. Europe is a little bit more advanced, and Japan is and China are in a remarkable world of negative population growth, which humanity in a non-wartime environment has never seen anything like it. So,
well, I think healthcare is an interesting thing because, if people are retiring, they're not working, they're aging, but they still need to spend money somewhere. They tend to spend it. The theory goes that they spend it on their health, right? So healthcare expense gets higher. As I said,
right? They spend it on taxes and their health because they don't want to pay taxes and they don't want to die.
Right. So, but in the same token, if their assets are dwindling because, a colloquial asset bubble is deflating, so to speak, then that poses now a headwind for it. And then you have the demographical shifts happening in different countries sort of at different times too. So, when you were in the hedge fund world, I feel like this is a lot easier to navigate because you have the capacity to take on so much more, maybe a lot more nimble, use complex instruments, trade markets, use a lot of derivative overlays.
Yes.
And going long and short, it's a different ballgame.
I'd love to tell you it's easier. It'd be just because we have those tools. It's It is very, very, very challenging to thread every needle. And
Well,
that's really what the job is in a hedge fund world when I did it, is to make money every single month. And historically, like, my math worked out where I would make money about 9 months out of the year, and I'd lose money about 3 months out of the year. And that would be my year. And I'd make, 1 to 2% in my positive months, and in my negative months, I'd lose sub 1%. And so at the end of my year, we would be up usually between 16 and 20, actually 30%. So about 16 and 30%. And that would be like our range, which was actually very high and pretty noisy for what we did. Again, we were in healthcare, which tends to be, especially in the SMID cap arena, very volatile. So that's really why we'd have this sort of like dispersion of returns. But year on year, it would look fine. We'd be up between 16. A terrible year for us would be high single digits. And the greatest year we ever had was about 30%.
yeah.
And you kind of weigh it out. And over a career, it ends up being around 20 to 23%, depending on how you want to weight things. You can do it year weighted, average weighted, even weighted, or capital weighted. There's like ways that you can weight how you're performed. So it's between 20 and 23%, depending how you cut it.
Yeah.
And that is an abnormal return for our product and what we did. And that's an unlevered return. That was very abnormal returns for what we did. And it was a lot of fun, but very 120% time consuming trying to thread every single needle. And that's what you have to do running a hedge fund. It's not for everyone. In fact, 80% of folks that do it fail.
Yeah, I didn't mean to, I didn't, my intent wasn't to say that it's easy to run a hedge fund. My intent was to say that you have more flexibility to try to thread a needle when you understand these dynamics and you want to trade cross markets or short companies or employ derivatives, which are things that can be more difficult to do, if at all possible, in something like an ETF like Pink, right? Like, you can't, correct me if I'm wrong, but in Pink, you can't just go short the entire healthcare market, tomorrow if you need to, or try to use a bunch of, call overlays on, one afternoon to try to overlay convexity for, an upcoming, what you think it could be a pivotal point in the market, the following week or something, right? It's tougher to do that. You're bound by prospectus, and have a number of constraints. And then you also have to make it a product that's reasonable and suitable for average people to own, right? The complexity, there's a limit to the complexity component, right? And so what are the
very
tools?
Much so. Our goal, and we're fortunate to do it, is to outperform in up and down markets, in healthcare up and down markets, and just deliver alpha.
Yeah.
So that if the healthcare is up 10%, at the end of the year, we're up 15. Last year, for instance, the benchmarks were up around 12%, and Pink was up a number that was much higher. I'm not allowed to say what it is because that would be promotion.
Yes.
So,
yeah.
And that's our goal.
Sure.
That is our goal, is to, and some years healthcare will be down, and our goal is to outperform healthcare in that down year too, so that when you look back on it over a 5, 6, 7 year period, all of a sudden you have compounded alpha returns.
Yeah.
And I can point to over the past 5 years, approximately. So since inception, so about almost 4.5 years, healthcare in aggregate is up around 24%, and Pink is up a number that is much higher than that. And that's really the joy of compounded returns. You get that alpha that compounds year after year after year. And that's really the goal and the gift that we try to deliver to our investors.
Well, I find it interesting because obviously there's so much talk about not being able to beat the market. And I always stop and ask the question, I'm like, what what market, and then the follow-up question is like, is that the appropriate market that you should be measuring against? Are you using the right yardstick here, the right ruler? And the question is, the answer is typically no, right? Everyone always benchmarks everything against, S&P 500. And at the end of the day, that's just it's not the appropriate benchmark for most investors. From a risk capacity. It's also not the appropriate benchmark these days, I think, from a diversification perspective, truthfully. Hey, it's no secret to us. We look at the demographics of this show. We know that a lot of you listening are actually other financial professionals and other investment advisors. We want to go ahead and invite you, if you're looking to do something different in your career, go ahead and reach out. We're always looking to bring on high quality people that understand how to do the planning process, align with our values, and are looking to deliver high value to their clients. Please just go ahead and reach out to us. You can get us on our website, ducharmewealth.com, and we look forward to talking to you. And so I think when you look at, when you drill down and say, okay, well, if I want to, have exposure to a specific sector, right? Like utilities or healthcare, I find as two sectors that there tends to be more alpha opportunities from active managers that know the industry and can provide the insights. And there's value to be had there that your odds, in my opinion, your ability to identify a manager that might be able to provide alpha is more favorable than, trying to pick a manager that beats the broad market consistently, right? So in your subsector, in your sectors or subsectors or industry groups, it's a different ballgame. And if you're looking to increase your exposure in that direction, I think there's a case to be made for active managers that can look at idiosyncratic opportunities or alpha opportunities and deploy them as needed and understand the market, environment that they're operating in.
Mm-hmm. And kudos to you for doing so. It is the hedge fund manager, to say that, like a big shop like Millennium, for instance, they have about 250 folks that are portfolio managers running money. And their job is to identify moneymakers that can make money rain or shine, or to, in their mind, even more importantly, not lose money. Because it's one thing to have someone who makes money. It's another thing to have somebody who loses money, because that is a huge problem for the entire portfolio, is a money loser. And so their sincere hope is that they have 70% of the PMs make money and 30% just don't make money, but don't lose money. And that's the ideal recipe for them. And that's pretty much how it looks like on the distribution. You have 15% that lose money, 15% that are flat, and then 70% that make some. And frequently about 20% that do very well. And then of that distribution, you have about a 5% of the PMs that tend to make money all the time, no matter what. And those are the real stars. That's what Millennium and Citadel is made for, to find those superstars and give them $5 billion books and have them run wild, because they are just the elite athletes for whatever reason. That's what they're looking for. It's very hard to decipher who and how and what makes a magnificent moneymaker. As you probably know by now, there is no book to teach you, oh, this is how you make money trading stocks, or be a hedge fund manager. This is how you do it. And here's your step-by-step guide, hedge fund manager for dummies. There is no guide. There is no book. There is none of that. You literally get this job. They give you a gun, stick you in the foxhole, and they say, I'll see you on Tuesday. I hope you're not dead. That's it.
Well, the irony is there is a lot of books. I think we both agree that none of them are going to do the job.
Well, they're going to fail, right?
Well,
you have, like I mentioned, you got 15% of books that are down every year, right?
Yeah.
So that's 15% that go. And that's why I say that about 80% don't make it. And it's usually in the first 5 years. Yeah. That 15% rolls through. It's for first 15%. Next year, it's another 15%. And it's pretty clockwork. About 15% do not make it every year.
Yeah.
And you do that for 5 years, and that's about 80%.
Well, when I said book, I was referring to like literal, paperback books that like there are books that, this is how to trade stocks or, One Up on Wall Street or, momentum factor investing and,
Yes.
blah, blah, blah. There is a lot of books out there and a lot of them have great things to learn, but
Mhm.
your ability to learn from those books in my experience is simply, you're going to read an entire book and say, okay, there was this interesting thing. And how do I apply that to a bigger system that I've developed for my style of trading or investing? Right. And so you can't just read one, like you said, you can't read hedge fund managers for dummies and all of a sudden, be some great manager. There's a lot of hands-on learning in the industry that is oftentimes painful and very tough emotionally to
Mhm.
deal with. But
It's very funny you say
it's
that, because I don't think I've ever read a book on investing in my life. Ever. Zero. Read about history, read about finance. Yeah. I've never read an investing book in my life.
Yeah, I have an undergrad in finance, and I'm currently in a master's program, master's of finance program, and so uh, whether I like it or not, I have to read some of these books.
Well, I mean, those books,
But
yes, but not. What I mean is like, how the business school is going to tell you how they think the world works.
mhm,
You need to read that. You
yeah,
need to read that because then you can understand how they're wrong, and that's really valuable.
hmm
I'll give you an example. They ran a psychological battery on me at Millennium because I was a unique thinking character, if you will, and they wanted to understand why I think the way that I do. And it was kind of, I didn't know it at the time. That's why they were doing it. And they came back to me with the results, and it was like 3 days of this stuff. And they came back and they said, "We've never seen this before." I'm like, "What?" They go, "According to your results, you believe 6% of what you read. 94% of what you read, you do not believe." And all I could think about when they told me that was, there's no way I believe 6% of what I read. It can't possibly be that high. That's really it. And then I literally do not believe almost anything I read ever, because everything that you do read is biased.
yeah,
Right? You are reading material in order to gain adoption of somebody else's view, and they are selling something. And that's what they're trying to do. It's just like the news. The news is the same way. I mean, especially mainstream news. I mean, what you really should do, and people never do it because it's easier to just turn on the TV and be enraged. Forget about that. Just read financial data. You'll understand everything you need to know about the world around financial data. Everything else is just noise. All of it's noise. Just look at financial data, follow the dollars, follow the numbers, and then the world starts becoming very, very clear. What's happening in China, why it's happening in China, why what just happened in Argentina is a very big deal, why what's going on in Brazil is a very big deal, why we did this with Venezuela, why Colombia, Mexico, Cuba is next, why South Africa is a gigantic problem, why Xi in China has blown about $2 trillion of money they don't have. And where's that money going to go? And how long is he going to last for? This is all just financial information. And that's the valuable stuff, because you can figure out what's going to happen next because of it.
that is a really interesting perspective. Obviously, I'm a market technician, and we always say like just focus on price, and I think that's maybe a more primitive way of saying the same thing, right?
Yeah, but that's
Like
coincident, right? If
yeah,
you're looking at a chart, you're looking at, you're probably looking at a 1 year duration at most, because you can't really chart past that. And it's important, it's valuable. But when you're thinking about what the policy is going to look like over the next 5 years, like for instance, this March and May, we're going to have municipal elections in France and the UK. And very likely they're going to go the wrong way in a big way. And very likely because of that, you're going to see a clamping down on free speech because they want to eliminate and cancel the opposition parties, which are, by the way, kind of a majority now in these countries. And you're like, well, why is everything out of control? Why are they canceling an entire population? Sort of like how the MAGA movement has been tried to be canceled, literally almost successfully canceled, which is the majority being canceled by a very loud minority. Calling everybody evil and you're Nazis and trying to get these people killed. It's because they've run out of money to borrow on the long end of the yield curve. And that's what's happened in the UK and France. They cannot borrow on 10-year plus paper at all. And Japan is in the same boat. That's why these things are happening. Money and access to money is getting very tight. And they have promises out there that were made to this public that cannot be honored. That like financially, when you just do the math, you're like, wow, this can't be honored. What are they going to do? Well, they're going to clamp down on the public and make them subservient and change the rules and print money. But you can figure all that out just by watching the dollars and figuring out, when do they run out of money? How do they run? And it's really, once you do it, like you can do it on a cocktail napkin. It's not that difficult. You just have to take a look at all the data and say, wow, that doesn't make any sense. It's sort of like Michael Burry in The Big Short when he was looking at the MBS loans in 2005. And he was looking at this and he's saying, this doesn't make any sense. How is this AAA paper? 50% of this portfolio is garbage. Oh, and then he figured out how they gamed the system to fool everybody. And then all he had to figure out was, when does it blow up? And that's just a search of the numbers, not the news, just the numbers. The numbers will tell you what's going to happen next. Not to the day, but certainly to the 5-year window or frequently the 3-year window.
Yeah. That's
so I try to do that the best that I can, along with everything else I'm doing, figuring out if drugs are going to be successful or not.
I find that interesting about your investment approach. I've kind of always been a little bit intrigued by the way that you think that way. And then combine it with, obviously your fundamental research on individual companies and kind of solving the puzzle that way. I think my observation, as we've talked, and gotten to know each other a little, is that you're solving the puzzle at all times, right? You really, there's all these unique pieces and moving parts, and I think you enjoy solving the puzzle, or trying to.
Yes. Oh, I'll never get it right. I'll never get it right. I mean, I've already given up on that. I'm never going to get it right. It's just, can I get close? Can I get close? Close enough to bet. Close enough to see what's probably going to happen.
Yeah.
And sometimes nobody sees it.
Yeah.
In fact, in the past 5 years, into COVID, out of COVID, the margin issues right after COVID, nobody saw all these things. And we could see them and bet accordingly and do very, very, very well. And it's all there in the numbers. It's just that people get distracted by sell-side research and words and TV and Black Lives Matter and a Palestinian craze and in Ukraine and all these things and all these crises. If you actually look at the real numbers of a country, and this is why China is so difficult, because all their numbers are fake. They're all man-made. And we're seeing more of that, like the BLS data out of the United States is no longer reliable. It's man-made. And this is why the Fed in their last meeting said, we're going to start printing money because our job numbers say it's crap. But they won't tell us what those numbers are, how they're different, how they got to those numbers, what they are, when they are, how long they've been doing this. But they said, we don't like the job numbers, so we're going to print $400 billion on the short end of the yield curve because of jobs. But BLS keeps going along and everything's fine. So what we just learned, for instance, and this is something nobody talked about, we talked about it just before this call. That was a great example, real time, where the Fed admitted to us that they are no longer using a data set of numbers that everyone is using to gauge the economy. One of the biggest ones. They're not using it. They're using their own numbers. They're not telling us how those numbers are, what they are, where they are, how they got them. And they're doing massive activities such as putting $400 billion on the short end of the yield curve to offset this. And they won't even tell us what it is. Thank you very much. Mic drop. No questions because people didn't even know how to address this. And I haven't even seen one article talking about it because it's so far off the menu, they don't even know what to say. Nobody's brought it up. Go back to the interview of the Fed after the last Fed meeting in December. This is what he said. That's what he said. We're using a different set of numbers. I'm not going to tell you. He didn't say I'm not going to tell you what it is, but he didn't tell us what it was. So he's not going to tell us what it is. You watch that, you scratch your head and you're like, oh my God, I thought the numbers were fake because it didn't match up with what I was seeing. I thought they'd been fake for a long time at the BLS. And now the Fed is admitting that they're not real numbers, but they won't tell us what the real numbers are.
Yeah, I think people don't have a grasp to of how big $400 billion is when they say that, well, we're just going to print $400 billion. I read something a couple months ago, and so to add context to this, Elon Musk, I know you don't waste your time following this kind of stuff, Mike, but I think his net worth is like projected to be somewhere like $80 billion or something.
Mm-hmm.
Okay. And it said, hey, so you could save $1 million a day since the birth of Jesus Christ, and you still wouldn't have as much money as Elon Musk. You know, and
or
that's
as many children.
Yeah. Well, and but my point is like his net worth is like 80 billion. You know what I mean? We're talking $400 billion like it's nothing. You're talking about several $1 million a day since the birth of the Christian Savior 2025 years ago. Every day, millions of dollars every single day for thousands of years.
Well, money becomes less relevant when there's this much M2.
Right. But my point is like $400 billion. Like we're used to hearing these big numbers come out of Congress. Oh, they're doing $1 trillion spend. They're doing,
yes.
It's like,
do you know the bailout in 2008 was $1 trillion?
I thought it was not even quite that much, but maybe combined.
It was about $1 trillion.
It was because I think like TARP, the original TARP program was a couple hundred.
That was just recently, $1 trillion and like an unbelievable number. So I'll give you a number that's really fascinating. It's pretty silly, and you just draw it on a cocktail napkin. Very simple to do. If you take the taxes that for people, you take all of our tax base, divide it by the population. And you say, okay, a family of four humans, their average contribution into the tax base is $60,000. And that includes cap gains, corporate taxes, everything. I just took all the tax base and I divided it by the humans in the United States. And then I said, let's make it a family of four. So 4 humans in the United States. What are they paying in to the federal government? It's $60,000. But what do they get back from the government every year? The number is about $90,000. So you're putting in 60 every year, but you're getting back 90 because the government is borrowing 30. So the public complains that I don't have enough money for milk and eggs and blueberries and all this other things and a car and the roof over my head and all that. And they don't even realize that the government is spraying money in their face through whether it be healthcare benefits, light bulbs, telephone poles, streets, roads, bridges, police, whatever, military. They are spraying money into this economy for the past decade, nonstop, at a level that's completely unsustainable and ludicrous. And stocks reflect that. So the public is enraged that they don't have enough money and they can't afford anything. Oh my God, they're receiving so much more money than they should. You cannot believe it. And it's not sustainable. That's what's happening.
Yeah,
And it's all right there in the numbers.
we have these conversations, and I always just think like, I don't own enough gold. However much gold I own, it's not enough. It's like
I feel like an idiot because I sold my gold like 12% ago, and it just exploded because I was like, it's up a lot. That's enough. We're probably going to get a pullback, blah, blah. Idiot. I'm an idiot. See, I still make mistakes.
Well, when we talked last April, you probably don't even remember this, but you said, you had told me like, man, it makes me sick to my stomach to even say this, but for the first time in my career, I'm long gold.
That's right.
It's like,
and I was Sizeola, Sizeola, and I sold all of it like a week or two ago. And then, Japan literally just has gone off the rails because they don't have a choice. And, they now have a leader who is saying, we're going to amp military spending and we're going to cut taxes. And that's really going to help us turn around. Totally not true. The horrific issue is they have negative population growth. That's the problem. And they have a debt bomb that's so huge, it's insane. And so if they're going to accomplish any of these goals, whatever these goals are, it's moronic. I mean, there is no solution for these people, They're going to end up spending and printing so much you can't believe it. And that's it. And that's what's going to happen. And Europe is next. I don't think that the euro survives the next 5 years. I think that 2027 will likely be the beginning of potentially the beginning of the end of the euro. And because the protest parties just got so big now that they are going to form a coalition. And once that happens, the first thing they're going to want to do is exit the euro and go back to their own currency, and they'll immediately print a ton of it.
What kind of dynamic do you think that plays out for the dollar, Mike? Because the dollar's really heavily, when you talk about
dollar's fine.
Well,
the dollar's fine.
What I mean by the
fine
dollar
because everything else is so bad.
Well, what
Remember,
I mean
it's
is
a
the
relative
Dixie.
game.
What I'm referring to is the Dixie, like the dollar index,
Yeah.
right? Like, so if you have like euro fall apart, I mean, it sounds like it would
The
be
dollar
really
goes
positive.
vertical. Yeah.
What's the knock-on effects that could have on the rest of the world if you're, like an international investor, or you get too heavy and seeking out alpha opportunities in EM or developed countries, or just wanting to be like a lot of people are just, I want to be globally diversified. Generally speaking, how does that play out?
I want to be globally diversified. Yeah, I mean, look, in my experience, everyone simply chases returns wherever they are.
Mm-hmm.
That's it. And in my predictions for this year, if you go on to Twitter, you can see them. I thought that I didn't mention that healthcare would outperform. I think it will, but the real outperformers, I think, is not going to be tech, and it's not going to be the U.S. I think emerging markets outperform, but that has a lot to do with flows issues, where once every so many years, emerging markets outperform. And gold actually materially outperforms, maybe all of it, but I don't really see how we get it.
It did last year.
Yeah, it did last year. That was pretty incredible. And I think we're going to see it again this year. And a lot of it has to do, looking at Japan. I don't see an exit. I look, we have negative populations and they can't have negative GDP growth. That's it. They can't, because if they have negative GDP growth, an incredible number of companies fail. And that means debt fails. And they can't have so much debt fail because that causes a depression. So the alternative is they print money. And that's what they're going to do.
I've talked about this quite a bit, and I read about it a lot. And I think the thing that people forget is it's really the first time in, modern history, so to speak, that the whole world is on fiat currencies. Like, there's really not a country out there that can't just not print more money to, inflate their GDP and try to keep their financial systems alive. And it's in their own best interest to do so.
Well, I think what we've learned probably when they look back on this, how this happened and how it's unfolded, is that if you organize and tax a society to a certain level, they stop having children. And I think that's what we crossed, is that Rubicon of where the taxes are such a stress on a household formation that people are getting married later. And because they're getting married later or not at all, they're having fewer kids.
Yeah.
And fewer kids exacerbates your tax base. And that's it.
Yeah.
And I think that is what we have witnessed now for a 30-year run. And here we are with such a debt bomb on us that they can't reduce the tax base because we're going to end up paying so much in interest on this debt alone. They can default on the debt. The way they default on the debt is printing money.
Mm-hmm.
But when you print money, you're actually stealing the wealth of the the non-savers,
Mm-hmm.
or the ones that don't own the assets, which is the masses. You're stealing the wealth from the masses with this inflation.
And you're saying that because the people that own assets, you can't print more of their assets. So the pricing of the asset just gets readjusted and whatever the new nominal currency.
Well, they get pricing power. If
Yeah.
you own the asset, you have pricing power because there's inflation. So your wealth gets protected. But if you're the renter who doesn't own the asset, you can only work for those dollars and pay the increased cost on for food, for whatever.
Well,
so inflation is a way to steal money from the masses that don't own assets. And that's the masses.
do you think to a certain extent it also steals the wealth from other pension funds or institutional investors that are heavily allocated to bonds and treasuries?
Yeah, it does. I mean, that's part of the financial repression, and it does. But those folks can always be not in those assets, and you can see. I mean, the most bizarre thing has ever happened is that the risk-free rate is no longer the risk-free rate. It has a lot of risk in it, and this is why, like, corporate bonds have massively outperformed sovereign bonds, like colossally.
Mm-hmm.
The masses do not trust government bonds because they know we can never pay them back, and they'll simply inflate it away. And so you don't want to own something that's going to pay you back with inflated printed dollars, such as treasuries. You want to own GE that's going to be able to pass on pricing power, and you're earning the free cash flow of the business.
Yes.
You won't get that pricing power out of a treasury. You will get screwed, where inflation's at 5%, but you're getting paid 3.5%. I mean, that's what they do. That's what's happening in Japan right now. I'll give you an example. I mean, if you look at Japan, right, and you look at the long bond, let's say 10 years, right?
Mm-hmm.
10-year bond, it's like 1.5, right? And it stayed around 1.5 until just recently, or less. But let's say 1.5 or less. Yet the yen dropped 40% in value in the past 5 years. How did you not get compensated in a commensurate interest rate in the 10-year yield in the treasuries? The currency loses 40% in value, but you're only making 1% a year on that 10-year? That doesn't make any sense. Well, it does if you find out that they're actually printing money and buying that 10-year to suppress that yield. That's what they were doing. So they basically stole about 35% of the buying power from a 10-year bond holder in a period of 5 years.
I mean, that's not too much different than that's doesn't seem all that much different than when the U.S. had bought the 10-year treasury and suppressed it to 0.5%.
Mm-hmm.
Just a couple years ago.
At that time when we did it, it was not terribly clear that we would never be able to pay this stuff back. And it's still not quite clear. We're almost probably there. But
Yeah.
in the case of Japan, it's overwhelmingly clear because they could never have organic GDP growth.
Mm-hmm.
Like they can't. they can't have organic GDP growth forever for a really good reason. There's like two of them. Number one, Japan is xenophobic. And number two, nobody speaks their language. So they could never import the people to make the population that could actually have positive growth. So they stole the money from the masses through inflation. And it already happened. People are like, oh, it's got to happen. I'm like, nope, just happened.
Well, what's happened the last couple of days in the Japanese bond market is nothing short of incredible. But
yes, but nothing short of wildly predictable. You just didn't know exactly when, the day, the week. You don't know, but it has to happen because this is the game they play.
Do you think as those yields explode that you have demand flow back into the yen, though?
Isn't that funny? No.
Like,
oh, because they're lining up for that one. No, actually, it's a really good point. It really is. I think the biggest risk for the yen and for the world markets is that the yen goes up. Because if the yen does go up, it will really help foster a massive carry unwind. The whole world sees this demographic problem for the past 30 years, 20 years. And so what you wanted to do was borrow in yen and buy in dollar, or most other things, but certainly the dollar, because you could get a real yield out of GE in dollars, but you're borrowing it in yen. And the price of that yen just went down 40% over the past 5 years. So say you bought $100 worth of yen denominated GE. So you sold 100 yen, turned it to dollar, and bought GE. GE has gone up and you've gotten a dividend. And all the time, the yen that you borrowed in is now worth 40 or 60 cents on the dollar.
Yeah.
So not only did you get the appreciation in GE, but you also made an extra 40% by doing it in yen terms.
Yeah.
And that's how the whole world is set up. Because when you look at the demographics, you're like, over any period of time, 10 years, 20 years, 30 years, how can I be wrong? I don't know.
President Donald J. Trump.
You're like, can't be wrong. Because they are simply going to trash their currency like they did. There's no way out, except for a gigantic depression, but that's politically unpalatable.
So you think on the yen, they'll have to somehow let the rates explode and still suppress and manipulate the currency down?
Yeah, I think we're doing that with that $400 billion. It's the beginning of that sort of situation. They don't want to do it. You don't want to do it. Look, the U.S. doesn't have to be the true blue straight arrow. Okay, all we have to be is better than everyone else, and that's going to be good enough. And so that's what they're trying to do, is walk the fine line of doing what they can, but making sure that we're more attractive than everything else. And the U.S. has a massive advantage in that regard.
Interesting.
Oh, by the way, this is why I'm not invited to Davos.
Yeah, this was the reason. Well, I appreciate you sharing all this stuff. It's always fun to talk to you. I do have I've got a trade idea I want to run past you after we get off, but I don't think it's appropriate to probably talk about it on online here. Anyways, well, I appreciate you taking the time to have the conversation. The first half, I think, was really relevant for people, interested in pink and what's going on there. The second half, it definitely just interested in terms of current events and what's going on in the world. But I think it still shedded some additional light on the way that you're thinking and looking about things, and the way that it connects back to how you're managing the book that is the pink ETF.
And I don't mean, like, people may come off and say, oh, Mike Taylor is so bearish, blah, blah, blah. I'm not. There's going to be incredible innovation. There are incredible trades out there, up and down, left and right. We just need to be unbelievably cognizant of the lay of the land of the world, and that we are in a unique moment in human history where I believe moving forward, it is going to be central banks versus humans. And for the most part, humans are kind of going to lose. But that doesn't mean we can't make an incredible amount of money trading that. And we just need to be very cognizant of it. And so that's what I try to do, is be as cognizant as possible when determining what I'm going to do next, and being very sanguine.
Yeah.
Because we're not here to right. Look, I can try to right the wrongs of the world in my own way through pink, doing something good. But I'm never going to solve the world's problems. I'm not going to make the world right. My job to you is to make, and my children, is to make great returns. And so that's what I really try to stick to, and understand that there isn't really a truth, is like what is going on in central banks and with humanity and these crazy debts and money printing. Is this sinister to humans? Can't look at it as sinister, good, or bad. It is. That's how you look at it, and just accept what is, and then figure out how to trade it. And that's really how I look at it. I try to, pull myself entirely away from good and bad and right and wrong, and simply understand what is, and then do the best I can.
Yeah. Yeah. Well, I appreciate you sharing all that with us. And obviously, if anyone wants to look up the ETF, they can find that information pretty much anywhere they find financial data. It's obviously very publicly available. And if anyone wants to follow Mike's thoughts a little bit closer on a regular basis, if you're on X, you might consider giving Mike a follow on X. Remind us what your handle is on X.
It's Mike_Taylor 1972. Though I look 10 years younger than 1972. So.
Well, you've got the edge in healthcare, so it makes sense. All right.
Thank you.
Well, I appreciate everyone tuning in, and with, as always, questions, comments, concerns, jokes, hate mail, we take it all. Go ahead and reach out, hit us in the comments, hop on our website, connect with us that way, send us an email, call us, whatever you want to do. We're here, happy to talk. And if there's ever a guest or a topic that you want us to bring on or talk about, let us know so we can arrange for it. We're happy to shed light on any financial topic out there. Thanks for tuning in, and we will see you guys out there.